Hey everyone, Mortgage Nerd here. What does it mean to have a fixed rate versus an adjustable rate? Well, fixed rate is pretty simple. Payment is fixed. Your payment's not going to go up, your interest rate's not going to go up, it's also not going to go down. So in some cases, some types of mortgages, right now where rates are at their peak, do you want to have a fixed rate or do you want to have a rate that might come down? Depends on the mortgage type, depends on the scenario. So what is an adjustable rate? It's also known as a variable rate. Sometimes you hear it called an ARM. It's not an ARM, it's an ARM, which is adjustable rate mortgage. So adjustable rate means just that. It's going to go up and down depending on the terms of that loan. If you get a home equity line of credit, that's an adjustable rate mortgage and it adjusts every month, no matter what, from the moment you get it. Why? A fixed rate mortgage is a closed-end loan. It's not open, it's closed, meaning banks give you money that you borrowed, so you make your monthly payments. If you pay extra on a closed-end loan, you can't pull that money back out. But on an open-ended loan, when you get money, you can pay it back, you can get it back out again. It's open-ended. It's a line of credit. Line of credits, open-ended mortgages are always adjustable. Now, this isn't to say that all adjustable rates are open-ended mortgages. You sometimes get an adjustable rate mortgage or a variable rate mortgage on a closed-end type of loan. So let's say right now you're buying a house and the fixed rate mortgage is 6.5%, but the adjustable rate is 6%. And that adjustable rate mortgage could be fixed for a period of time. So it could be fixed for 3 years or 5 years or 7 years or 10 years. So it'll be fixed for that period. And then after that, it'll adjust either monthly or annually, depending on that type of loan. Sometimes it's every 6 months, really all depends. So if that rate is lower than the fixed rate and you're educated properly by someone like me where they tell you mortgage rates will be going down in the next 6 to 18 months, or better said, in the next 6 to 18 months, you'll have an opportunity to refinance to a much lower rate. So instead of a 6.5 fixed now or a 6% ARM, it might be 4% or 4.5% in the next 6 to 18 months. And then it's worth refinancing and paying closing costs all over again to bring that rate down. But what we're finding is not all adjustable rate mortgages right now are lower than the fixed rate. So you might get an adjustable rate mortgage that is 6.7% and the fixed rate is 6.5. Just go with the 30-year fixed mortgage. It doesn't make sense to do an adjustable. But remember again, home equity lines are adjustable. So when the Fed raises interest rates, which we're talking about raising them again this year and then keeping them high, that adjustable rate mortgage, that home equity line of credit will go up and will stay high. Those are 7, 8, 9% right now, but it's usually a second mortgage. Sometimes it's a first mortgage. I digress. We know those mortgages are going up and staying up, but in the next 6 to 18 months, the long-term mortgages, whether they're fixed or adjustable, are coming down because they're driven by the bond market. And right now, inflation is what's kept those mortgages up. So as inflation comes down, those long-term mortgage rates are going to come down as well. That's why I say there's going to be a refinance opportunity in the next 6 to 18 months. I hope this helps you understand the difference between an adjustable rate mortgage and a fixed rate mortgage. And hey, if you have any questions, put them down in the comments below and I'd be happy to make a video specifically for that question you have. Mortgage Nerd out.